rise. Was yesterday the signal of the economy collapse? We're going to break that down today. My name is Coach JV. I am the top health, mindset, and crypto coach in the world. What you believe in your heart, you think in your mind will eventually become your words and become your reality. If you can see it in your mind, eventually you can hold it right here in your hands. What you repeatedly do gets ingrained in your subconscious mind. What gets ingrained in your subconscious mind becomes an unconscious activity. The news is coming at you fast and furious, warriors, all the distractions. We got the new variant coming out, which is going to start to distract people. We're going to break down what Jerome Powell said yesterday and how is that going to affect the economy. Before we kick it off, if you want access to my portfolio, revolutionary exit strategy, access to our crypto 2.0 courses, what is crypto, how to do it, and an example, multiple calls throughout the week. And we're all starting our 120-day challenge together on January 3rd, 2021. So get your spot today. Click the description down below to join the Private Warrior Academy. All right, so let's jump right into it, Warriors. So if you were paying attention to this, on November 3rd, 2021, Powell says Fed will discuss speeding up bond buying and tapering at December meeting. So the Federal Reserve, Jerome Powell, said he expects policymakers in December to discuss accelerating the timetable for tapering of monthly bond purchases. Doesn't mean they're going to stop bond purchases. What that's going to do, it's going to slow down the money printing. So speaking before the Senate panel, he said tapering could wrap up in a few months sooner than anticipated. That would open the door to interest rate hikes thereafter. Okay, let me repeat that. That would open the door to interest rate hikes thereafter. Powell also said it's probably a good time to retire the word transitory to describe inflation. So basically, he's eating crow. He's like, oh, shit, we fucked up. We're at 6%, 6.2% in October. Inflation is out of control. You got Turkey is collapsing. Their monetary system's collapsing. Venezuela has collapsed. America came in at 6.2%. I just saw gas prices in Arizona over $4. Your job market, it's interesting. Well, let's listen to what he has to say, and I'll narrate it based on what we know as facts, figures, numbers, logic. They use these words like transitory. They use these words like let's go ahead and retire the word transitory because they know they messed up, Warriors. They know that we have an out of control vehicle basically right now that is going to crash. And what they're going to do, Warriors, is they're going to move you into a central bank digital currency. That is going to be the solution to this problem. Okay, so let's listen to what he has to say. Let's absorb what he has to say, and then I'll narrate based on my perception of what's going on.
The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis.
Okay, so only time will tell if we reach sustainable inflation at 2% basis. So he took out the word transitory, so he's changing the language because they know they screwed up. They're running hot at 6.2%. right? So basically, if they keep the inflation going, if they keep interest rates low, but if they start to taper, usually, well, we're going to watch one more thing and then we'll break this down what happens when the Fed starts to taper, right? Ray Dalio is one of my favorite economists. We're going to take a look at what he's saying about this, right? Don't believe some long-haired hippie dude. Let's look at the facts, figures, numbers, and logic of people who are in the game and understand what's going on. So here's Powell's opening statement at the meeting yesterday. So let's take a look at this. Let's just listen to some of the things he said. Like, think about maximum employment. Go to like a grocery store, Warriors. There's help wanted signs everywhere. Nobody wants to work. Everybody's getting stimulus checks, Warriors. So I don't know where they're getting this maximum employment from. These companies are surviving off of these stimulus checks. They're surviving off the money being pumped in the economy. So when they start to taper, it's going to expose the zombie economies, the zombie companies, excuse me. And as inflation goes up and the money starts drying up, they're going to switch us into the new monetary system because that's going to create the gap in between the rich and poor.
The rise in Delta variant cases temporarily slowed progress this past summer, restraining previously rapid growth in household and business spending, intensifying supply chain disruptions, and in some cases, keeping people from returning to work or looking for a job. Fiscal and monetary policy and the healthy financial positions of households and businesses continue to support aggregate demand. Recent data suggests that the post-September decline in cases corresponded to a pickup in economic growth, and GDP appears on track to grow about 5% in 2021, the fastest pace in many years. As with overall economic activity, conditions in the labor market have continued to improve. The Delta variant contributed to slower job growth this summer as factors related to the pandemic, such as caregiving needs and fears of the virus, kept some people out of the labor force.
Okay, so that's key. They keep using the C word as the catalyst to come up with their excuses of why things are happening. So now do we have now? We have the Omicron or whatever it is now. So now we have a new variant as they're starting to taper.
Despite strong demand for workers. Nonetheless, October saw job growth of 531,000 and the unemployment rate fell to 4.6%, indicating a rebound in the pace of labor market improvement. There is still ground to cover to reach maximum employment for both employment and labor force participation, and we expect progress to continue. The economic downturn has not fallen equally, and those least able to shoulder the burden have been the hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. Pandemic-related supply and demand imbalances have contributed to notable price increases in some areas. Supply chain problems have made it difficult for producers to meet strong demand, particularly for goods. Increases in energy prices and rents are also pushing inflation upward. As a result, overall inflation is running well above our 2% longer run goal, with the PCE price index up 5% over the 12 months ending in October. Most forecasters, including at the Fed, continue to expect that inflation will move down significantly over the next year as supply and demand imbalances abate. It is difficult to predict the persistence and effects of supply constraints, but it now appears that factors pushing inflation upward will linger well into next year.
So he just singled to you, supply chain. These things are going to factor well into next year. So people are saying that, oh, this isn't going to, people aren't going to, this was bad. Some people are saying this is bad for cryptocurrency, whereas people are trying to get their money the hell out of the dollar. They're trying to get their money out of the system into something that is going to hold value.
In addition, with the rapid improvement in the labor market, slack is diminishing and wages are rising at a brisk pace. We understand that high inflation imposes significant burdens, especially on those less able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risks to the employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions.
So basically what we're telling you is we're going to start tapering. We're moving into a new monetary system. Inflation's going to run hot. That's how they're going to keep the economy going. They're going to separate the rich and the poor. The middle class are going to get wiped out, leveraged towards technology. Look at this right here. I mean, whereas this came out, November 10th, October was at 6.2% in October, the biggest inflation surge in 30 years. It's set up for the biggest financial collapse in our history. So let's take a look at here. So what happens when the Feds taper? So as the Feds ease the pace and pares back the amount of purchases, tapering begins with the ultimate goal of sending interest rates back to normal. Okay. Tapering can impact long-term interest rates as a typical sends a signal to the market that the Fed is shifting to less accommodative policy stances in the future. The key is to understand that tapering does not mean the Fed stop purchasing assets, but it just reduces the pace of its balance sheet expansion. This is different than tightening, which means the Fed will no longer add assets to the balance sheet and will instead reduce the assets it holds by selling them. So usually when they start tapering, that is an increase in interest rates. So now you're tapering back the amount of money you're putting into the system. Interest rates go up. Okay, supply chain management is being squeezed right now. People aren't going back to work. Your products and services are getting more expensive. They're raising salaries, right, for the people that are working. And so what this does is it squeezes the small business owner. It's squeezing the only people that are going to survive is the ones that can be bailed out, like the large companies, right? So we're going to be monopolized by the Walmarts, the Amazons. That's why getting into blockchain technology or investing in AI and cryptocurrency, these things are so important, not financial advice. That's what I've been doing. Aside from interest rates, tapering could have an impact on the US dollar. The trajectory of the US dollar is important for investors as it impacts everything from commodity prices to corporate earnings. Higher yields make dollar-denominated assets more attractive to income-seeking investors, okay? So tapering is typically bullish for the dollar, as it means a move towards tighter monetary policies. But if you really listen to this and break this down and pay attention, that's why I pay attention to Ray Dalio, people who are facts, figures, numbers, logic, not the government who's trying to manipulate you and control you. But let's take a look at what Ray Dalio says about the tightening that the Feds are doing. This was back in June 21, 2021.
Investor, we've seen that pivot of some kind by the Fed last week, quite a calm market reaction. But should investors generally be taking this threat a lot more seriously?
There are different kinds of inflation. I'm not particularly worried about the classic supply, demand pressing up against supply, although we'll find out soon because there's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are
so now this was in June. Now what happened? He was exactly right. Inflation went up, but rental prices actually went the opposite. They went up.
And if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation? And also, what is happening with all this liquidity? Because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments. It pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like, to borrow houses right now, I mean, to buy, I'm seeing interest only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon, and the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
Okay, so that was in June, and now here they are. They're starting to tighten. And so what's going to happen is, here's what I think is happening. Now, I could be wrong. You can comment down below. What I think is happening is what they're going to be doing is they're going to be tightening slowly, right? It was a signal to the market. We're going to be tightening because they're ready to move us within 2022 to a central bank digital currency. So what they're trying to do is they're trying to continue to make the dollar look attractive, right? They don't want everybody running towards these assets. So they're trying, it's kind of like this, as you look this way, right? We want to go this way. And so now what's happening, they're starting the tightening. They got us to 6, this transitory. He took out the word transitory. And I know this stuff isn't exciting, but you have to know this stuff, Warriors. So he takes out the word transitory because they screwed up. 6.2%. They're running hot. The companies can barely afford to operate. They got supply chain management problems that, you can't get microchips for cars. All this stuff is going on. So they're like, oh shit. Okay. So we can't, if we just keep going up, right, in inflation, it's going to completely collapse, right? So what we're going to do is we're going to slow down the bond purchases. We're going to start tapering, right? We're just going to create this massive separation. And then maybe we'll come back and support people through a CBDC. And we can just look this up, right? You can just look this up, Warriors. Just go Fed now. Fed Now. Okay, so if you just take a look at Fed Now, you can go here, boom, Fed Now services. It's all set up. It's ready to go, Warriors. This is the Federal Reserve, FRB services.org. If you look on this, you look at, they basically have it set up so you can do digital wallets. You got central banks. I mean, it's wild, Warriors. You can take a look at all this stuff. This stuff has been set up for a while. It's accelerating your cross-border payments. Everything's set up, Warriors. They're allowed to, federally chartered banks are set up to custody your cryptocurrency, to hold your wallet, a pass-through account for the Federal Reserve, for the central bank. So what I think is happening, they're just playing with people's emotions, right? They're inflating the economy, supply chain management problems. Now we have the Omicron variant. So now there's a total another variant that's going to lock everybody down again. All the fear starting again, lock everybody. What I believe is happening. This is all to push us towards technology. It's to push you to a digital wallet. It's to push you towards understanding that cash is dirty, right? That to be able to get your money quickly and efficiently, you got to move your money at the speed of light. We'll get supply chain management to speed of light, and everything's going to operate on a blockchain, Warriors. So slowly and methodically, they're preparing us, but we're getting prepared. So, Warriors, it's time to activate. It's time to understand the game so you can't be played, Warriors. So we're here to support you. If you want to join our private Warrior Academy, click the description down below. Remember, I only have one Instagram profile. It is down below in the YouTube. Okay, so if you and on my Instagram, I did do a automated message to let you know. If you get an automated message, you'll see it. So, the scammers, you'll see I have my link in there with just my stuff. I do not invest people's money. We only have a private Warrior Academy and education academy. Okay. It's all the links are in the description down below. So I appreciate you guys. I love you guys. As we always say, Warriors, rise, get your shit together. Let's go.